How much could inflation impact the Federal Reserve's next moves? That's the question causing a stir in economic circles this week. As the economic landscape shifts, this question has gained increased importance and urgency. The answer to this query has far-reaching consequences. If we look at the current state of the United States economy, we can understand why. In the United States, inflation concerns are on the rise, a trend marked by growing consumer prices. These prices, which are climbing at the swiftest rate in over 3 decades, are causing widespread concern and instigating discussions among economists and policymakers alike. This price surge, which is the steepest history, has not gone unnoticed by the public. The rising cost of living, reflected in everything from groceries to housing, is putting a significant strain on American households. This inflationary pressure has put immense strain on those in power, particularly President Biden and the Federal Reserve, to react. The situation demands an immediate and effective response. There is a growing expectation from the masses for a robust action plan to combat this economic turbulence. The stakes for President Biden and the Federal Reserve are incredibly high. Their decisions could potentially alter the course of the nation's economy. In the face of these challenges, some economists are advocating for a more aggressive approach to combat inflation. These proponents believe that a hardline stance could stabilize the economy and restore public confidence. To them, strong and decisive monetary measures could be the key to reining in uncontrolled price growth. Conversely, others, like former Fed economist Claudia Sahm, argue that the economy still trillions of dollars in stimulus. From their perspective, the economy is still fragile and needs a supportive push to recover fully. They contend that a precipitous tightening of monetary policy could stunt economic growth and hinder recovery. Inside these debates, and as they unfold, the Federal Reserve's upcoming decisions could potentially reshape the economic landscape. They will unavoidably have a balance between fighting inflation and supporting economic recovery. This precarious tightrope walk illustrates the complexity and critical nature of managing inflation in today's economy. So, how much could inflation impact the Federal Reserve's next moves? That's the question that will continue to dominate headlines and policy discussions as the nation looks towards a potentially turbulent economic future. Some economists are pushing for a more aggressive approach to combat inflation. Others, like former Fed economist Claudia Sahm, argue that the economy still requires trillions of dollars in stimulus. On one side of this debate, we have the Federal Reserve, a central banking system of the United States, created to provide the country with a safe, flexible, and stable monetary and financial system. They've recently made a groundbreaking decision that has sent ripples through the economic sector. This decision is to no longer consider public health data, a major component of which is stark information about prevailing health conditions, assessment of economic conditions, and monetary policy changes. In a broad context, public health data is an essential tool in shaping economic policy. It gives a snapshot of the overall health of the population, directly correlating with worker productivity, healthcare costs, and ultimately, the economy's overall performance. It presents a comprehensive picture of the state of healthcare, including disease prevalence, illness-related work absences, and the healthcare sector's financial burden, all intertwined with the economy's health. However, the Federal Reserve's decision to omit public health data from its economic evaluations is a significant departure from the norm. This unprecedented move has attracted attention, stirring debates among financial analysts, economists, public health experts, policymakers, and the general public. Among the public health data that the Federal Reserve has decided to ignore, the effects of long COVID are particularly significant. Long COVID, a term used to describe the effects of COVID-19 that continue for weeks or even months beyond the initial illness, has become a concerning public health issue. It is characterized by a range of symptoms, such as fatigue, shortness of breath, brain fog, fevers, gastrointestinal symptoms, anxiety, and depression. These symptoms can significantly impact a person's ability to work, contributing to labor shortages. These labor shortages, in turn, have a notable effect on the economy. They cause businesses to struggle to find employees, potentially slowing down production and services, leading to a decrease in the supply of goods and services, ultimately driving up prices. This kind of wage inflation could pose significant challenges to the country's economic stability. This decision by the Federal Reserve comes despite some experts arguing that long COVID is a significant factor contributing to labor shortages and high wage inflation. There are those who believe that ignoring health data, particularly the effects of long COVID, could potentially blindfold policymakers to the real economic implications. This is a highly debated issue, with strong arguments on both sides. The Federal Reserve's decision could have far-reaching impacts on the U.S. economy, which we will continue to monitor closely. Adding to the complexity, we're witnessing fluctuating earnings outcomes from certain giants in the technology industry. The volatility of these earnings reveals a fascinating picture of how the big tech sector is performing in the current financial climate. Meta, formerly known as Facebook, is one firm that is currently experiencing a surge in its stock market value. This surge is perhaps reflective of Meta's recent endeavors to diversify its interests and move away from being a social media titan towards becoming a tech pioneer. The company's shift towards the development of the metaverse, a virtual reality space where users can interact with a computer-generated environment and other users, presents new opportunities for growth and profitability, hence the investor optimism. Contrary to Meta's triumph, other significant players such as Apple and Google are experiencing a slump in their market values. This unsettling trend is a stark contrast from their usual strong, upward trajectory. While both companies have solid product portfolios and reliable consumer bases, their declining stocks might be an indication of investor skepticism surrounding their future growth prospects. Apple, a brand synonymous with innovation, has come under scrutiny for its reliance on iPhone sales. With competition from Android devices heating up, it seems investors might be questioning Apple's ability to maintain its dominance in the smartphone market. Similarly, Google's parent company, Alphabet Inc., despite its diverse business model, is seeing a dip, perhaps due to its overwhelming reliance on advertising revenue. In the same vein, Amazon, another key player in the tech industry, is predicting a slowdown in sales for the following quarter. This forecast could be due to a variety of factors, including changes in consumer spending habits, the impact of supply chain disruptions, and increased competition from other online retailers. Moving away from the tech industry, another significant market indicator to watch is the upcoming U.S. jobs report. This report, a reflection of the nation's employment situation, is projected to show a significant drop in job additions compared to the previous year. Economists and financial analysts around the globe are closely monitoring key indicators such as average weekly hours and temporary help services in their attempts to gauge the strength and resilience of the labor market. The upcoming U.S. jobs report is anticipated to show a significant drop in job additions compared to the previous year. Economists are closely monitoring indicators such as average weekly hours and temporary help to gauge the labor market's strength. Then there's Jerome Powell, nominated by President Biden for a second term as the Fed Reserve Chair. This momentous decision undoubtedly signifies continuity, but also opens the door for potential modifications in the country's economic policy, stirring curiosity and speculation. So what is the larger context here? Inflation, a term that has been making headlines recently, is a burning issue. It's causing the Federal Reserve, a body that's been relatively unflustered until now, to potentially reconsider its strategies and future of action. With prices rising at an unprecedented rate, the consumer's purchasing power is shrinking, causing widespread concern. This situation is nudging the Federal Reserve towards reevaluating its current approach. But what's driving this pressure on the Federal Reserve? The answer lies in the cascading effects of various factors. The lingering influence of the long COVID pandemic on the labor market, with labor shortages and fluctuating productivity, is one such significant factor. As the economy tries to recover from the pandemic's blows, the labor market experiences mixed results, creating a sense of unpredictability and volatility. Moreover, the mixed results from big tech are adding another layer of complexity. The tech giants, which have been largely driving the economy, are now showing mixed trends. This uncertainty in one of the most influential sectors of the economy is undoubtedly feeding into the overall economic sentiment and impacting the Federal Reserve's decisions. Add to this the potential for weaker jobs report. With various sectors still reeling from the pandemic's effects and facing a labor shortage, there is a possibility that the jobs report might not paint a rosy picture. This factor could sway the Federal Reserve's calculations and strategies further. However, it's not all clouds on the horizon. There are silver linings too. Some market analysts are forecasting a potential Santa rally, a phenomenon that could spur stock prices to surge this winter. This rally could provide some respite to the investors and boost the overall market sentiment. In conclusion, the impact of inflation on the Federal Reserve's plans is anything but straightforward. It's a complicated puzzle of various economic elements, trends, and unpredictable factors. The situation is fluid, ever-changing, and all eyes remain focused on the Federal Reserve's next steps. To navigate these unpredictable economic waters, it is critical to stay informed and keep a close watch on how these trends develop. After all, the economic world is always full of surprises, and understanding them is key to navigating the ebbs and flows of the financial tide.